Our first guest this morning talks about the office sector taking off after a promising first half, with leasing demand up 24% to 685,000 square meters. The Bay Area and Makati leading the charge, while in the residential market, it's cautious on condominium projects, although noting loans for single detached houses still went up. To help us unpack the numbers and what they mean for investors, Mikko Barranda of Leechiu Property Consultants joins us live. Mikko, good to see you. Thank you so much for being with us today.
Good morning, Mimi. It's great to be back.
So, Mikko, what is the vacancy rate for office spaces here in Manila?
I guess maybe just before we dive into that conversation, we just want to reiterate and reinforce how blessed, lucky we still are here in the Philippine office sector. We've been tracking what's happening in the U.S. today, in the office sector particularly, and soon enough they may reach 25% vacancy levels in the U.S. Due to different factors, reluctance of people to go back to the office, interest rates. But essentially, what does 25% mean in the U.S.? That's 160 million square meters of vacant space sitting in different parts of the U.S. To put that in perspective, the entire Philippine office market is 18 million square meters. Imagine all those buildings empty and multiply that by 8 is what the U.S. is experiencing now. Now, on the flip side, our vacancy levels are at 17%, just to answer that question, and it's close to about 3 million. So still a lot, but not very far from other countries. Hence, the title of our briefing is Clear Skies Ahead. We do feel like we're on a very good track, especially for the first half of the year when we look at demand.
So what's different? Why do you think the U.S. is seeing a near 25% vacancy rate? That's actually a Moody's estimate for 2026. Why do you think they're seeing that and the Philippines not so much?
Yeah, I think if we look at the demand for the first half of the year, as mentioned, it's 685,000 square meters, 24% above from last year. And we have to just dive into dissect the demand drivers particularly. So it continues to be the IT BPM companies. It continues to be traditional offices. We've seen government agencies actually take a lot of space for the first half, about 7 times as much compared to last year. And the pipeline still looks good. We've also adopted to hybrid working and remote for many companies. But, companies continue to still grow, continue to still need the office. So, we talked to a lot of people, and then they do feel like, isn't the market soft? And, it's hard to really feel the market doing well today just because of the amount of supply being injected. Imagine in the last 3 years, including this year alone, we have injected close to 3 million square meters of office supply. So for every 1 square meter that's leased, another square meter is built. And optimism, at least from our side, is we're seeing that in 2025, the supply will drop significantly by as much as 50%. So we don't see the market today as a demand problem. It's more of there's just a lot of supply that all clustered all together. And it's just finishing up from all the delays happened in the pandemic and the years previously.
Just very quickly, we're looking at page 3 of your report. Aside from ITBPM, which you mentioned already, transactions for that sector increasing by 13%. Compared to the first half of 2023, you did note how leasing activity for government agencies increased by over 7-fold in the first half of 2024. That is a year-on-year comparison. How do you explain that 7-fold jump in transactions for government agencies?
We had visibility of many of these government agencies, and it, of course, takes time for many of these deals to take place and to be completed, and we've seen that since last year. It's a confluence of many of these government agencies, or the ability to really be able to make sure that the move or the relocation happens, and it just all happened at the same time. In terms of motivation, a number of them is purely also on upgrading where they are. Many of these government offices are derelict, they're old, and many have the mandate to move into something more quality, a better building, and that's part and parcel of what we're seeing in terms of flight to quality opportunity for many occupiers today. We've dissected the demand, and we've seen that majority of the occupants have moved in buildings that are 5 years or older. Essentially, these are buildings that were finished in 2018, 2019, moving from older buildings, and at the same time from buildings that are grade B and above, given that there are opportunities in the market today to be able to capitalize and then somehow afford those properties where they weren't able to back during the pre-pandemic days.
So, Mikko, I imagine a lot of our viewers are on the are on the landlord side, rather. What is your advice to landlords today who may be seeing lower rents and lease turnovers? You're saying that it's not a demand problem. We're just trying to fill up the supply that's there. What do you advise them to do? Do they wait this out? If yes, for how long, though? 2025?
Yeah. I think what's the best way to answer that is really we can't be fixated on the vacancy levels as a whole. We can't look at 18% as 18% per district. What we do is look at it from each of the districts. How is each district performing in terms of supply, demand? We know that core districts like Bonifacio and Makati are already close to sub 10%, while other districts are experiencing more. When you talk about demand verticals, it's also dependent, meaning most of corporate multinational companies will choose business districts over non-business districts. But if you look at the proliferation of the BPO industry, it's all about talent acquisition, talent scalability, and really to listen to where the demand is in each of the districts, as opposed to just looking at this big number, which is 18%, which is 3 million square meters. And from there, positioning whether a particular district has opportunities to build. And we've seen developers today, even though supply is there's a surplus of supply, they're building for 2027, 2028 in anticipation when supply will be one of its lowest, the lowest.
All right. So let's take a look at page 5 of your report, where you talk about combined demand for Bay Area and Makati City is 155,000 square meters, 44%, wow, of total Philippine demand. 77% of demand in Ortigas is traditional companies. Outside of Metro Manila, it's actually in Cebu. This seems like consistent with the previous trends, right? These are the usual suspects for areas that are seeing strong demand. Are you seeing anything? Does anything stand out from this list?
Yeah, I think it's good to note that the Bay Area in specific, for a while it was experiencing a lot of vacancy given a lot of POGOs that have contracted there. And many of those buildings were sitting empty for a couple of years. And it's good that many of these government agencies went in and picked up most of these real estate. So I think that's good to take note of. And Makati, of course, as mentioned earlier, it is the immediate district that many companies will look into expanding or relocating from, especially if the buildings that are available are of quality. So not indifferent, but provincial, still heavily dependent on the IT BPM industry when it comes to expansion. Hence, Cebu has done really well, at least in the first 6 months of the year.
You mentioned POGO. Do you think the POGO boom narrative is done? Is it over? Or are you still holding out hope that it will come back in the same big way that it did a few years back? Because, we're looking at page 7 now. If we could just flash page 7, contraction stabilizing in the second quarter of 2024. 42% from Q1 2024 is attributed to the absence of contractions caused by the POGO industry. So what is your longer-term view on POGOs, I guess?
Yeah, I think we have to accept the volatility side of the POGO industry, and it's hard to really predict where it goes. But one thing is for certain, at least they haven't been growing as much since 2019. For the first half of the year, they took 70,000 square meters. And even though if they decided not to lease that space, we would still be a market where it's net positive, and that will easily still be 600,000 square meters. So we're not ultra dependent in just one industry. It's a more balanced demand pie, I would say. But they still have been taking space, not just at the same level as they used to before. There are existing operators still here. They're like any other business. If they do well, they take more space, but not anymore to the same extreme and that they were behaving before.
Mm-hmm. And when you look at the overall behavior of tenants today, do you see them cutting square footage or shifting from multi-year leases to shorter-term arrangements? What trends are you seeing from the tenant side?
Yeah, that's a very good question, maybe. And what we try to do is really dissect the demand in understanding the behavior and motivation of why they lease space. And what we found out is majority of tenants that are taking space today are either expanding. Maybe they're not expanding the same footprint as before, where a BPO would take 10,000 square meters, but they're still taking more than what they need. And majority also of tenants are looking to relocate given the opportunities on that flight to quality. But we're at a certain point in the market that it's not only a lateral shift. It's not just one. They're taking space and they're leaving space and taking the same amount of space somewhere else. But we're seeing some growth. And I think that is where we want to be, where it is a reliable and dependable demand as opposed to it be superficial.
All right, all right. Final question. With all of these challenges in the office market in the short term, in current condition and short term, are you seeing a possibility that, enough of these office spaces will eventually be torn down or converted into another form, maybe warehouses or data centers, maybe even residential space?
I think that's what they're doing in the U.S., trying to, experiment on how to repurpose their office space. I think we're not yet in that market. There's still positivity that, it is just a matter of time whether these buildings get leased out, and not to a point where it has to be repurposed. I guess some of the older ones will most likely redevelop and try to renovate just to be more appealing to tenants.
Mm-hmm. All right. Speaking of the residential space, let's take a look at the residential pipeline of condominiums, the bulk of which are in the Bay Area and Ortigas. This is page 13 of your report. What are you seeing from your perch when you look at the residential side? Are you also seeing, wavering demand and increasing borrowing costs, slamming valuations there? Or would you say that the residential space may be painting a different picture altogether?
We've been seeing a lot of rebalancing in the residential space. There's a bit more growth and in the horizontal. I mean, many developers have already announced many projects, mixed-use township developments focused on building outside Metro Manila. And many of these projects that have been built before have shown really good returns, 15, 17% CAGR. And many of the developers are looking at replicating that and land banking and building that side. Of course, vertical continues to be core Metro Manila asset, and many of those that have land in core districts will build, but will also be very careful of what to build and whether it fits the market. Now, the residential space is also heavily dependent, of course, on how interest rates are, and it's good that BSPs now there's that opportunity to cut rates very soon, at least in the third quarter, fourth quarter, and that will send a very good signal to the market, at least for both the developers and those that are buyers, to be more optimistic.
Mm-hmm. But valuations-wise, what sort of growth are you seeing in the prices of land, for example, in the residential space? Would you say because BGC and Taguig currently have the lowest unit inventory, does it mean that the prices there are, higher in general?
Yeah, I think at least the capital appreciation or prices have gone up modestly, although the yields have not gone up at the same pace in terms of at least the rent. So yields have also somehow been affected by that. But the core districts, at least there's still quite a lot that are buying for end use, at least those that are buying for investment. They're able to still capture that, able to rent it out, maybe not at the same price as they would have before, but still a very good bet in core.
Mm-hmm. Clearly, so many people are getting into landed homes because loans there have gone up, and we talked about price growth. Now, here's the exciting part for those who are looking at the prime villages, where the rich and the famous and the powerful live. What are you seeing? There you go. We're actually flashing this chart right here. So what's the story here for prime villages?
I think it really is just showing that at least the luxury market is unhampered, very little debt levels. And amongst at least through the years, whatever crisis, whether it's an inflation crisis, GFC, COVID, land prices in these villages or these houses have continued to go up. But also there are not many deals, meaning that there aren't that many owners selling houses or selling houses last month. Transactions.
Mm-hmm. Mikko, I just wanted to flash this chart to make it a little bit bigger so people can actually see. So Forbes Park is still the most expensive, $642,000 per square meter. The asking price per square meter actually went up by 6.4%. Dasma Village is at $635,000. It saw an appreciation of 1.1%. Green Meadows is third, $283,000 per square meters, up less than 1%. Ayala Alabang at $231,000. That's the light blue line. At number 4, $231,000, up 1.3%. Are there new areas, new prime villages that are, emerging as we speak?
Yeah, I think at this point in time, if you look at, there's really not much land in Metro Manila anymore to build villages.
So where should investors look?
I think we just follow infrastructure projects. A lot are now invested in South Luzon, Calabar Zone area. We're seeing where these I guess township developments are located. Of course, real estate is a long-term play, so it's a 10-15 year play, and then it's a huge commitment. But I think that is where it's headed. It's really looking outside Metro Manila for opportunities.
All right. And on that note, Mikko, thank you so much for joining us this morning to talk about the challenges and the opportunities in the real estate market. Thank you again for the time and the insights. We'll see you soon for the Q3 report.
Thank you so much, Mimi.
All right.